Hi, everybody. Welcome back to Stop Being Sold. My name is Michelle, and I'm here with Brian. And in today's video, we're going to take a look at the rising rates and the rapid spike in the 10-year Treasury note and discuss exactly what it means for you, your money, and your investments.
Yeah, Michelle, this might not be the sexiest topic, but it's important, and we've had a massive spike in the past few weeks in that 10-year Treasury note. So.
All right, so Brian, before I dive in and start asking you questions about this, if you're enjoying the content of the videos that we put out, if you like the content of the video today, make sure to hit that like button and also subscribe to the channel and hit that notification bell so you never miss another video from us on how to stop being a transaction and become an informed consumer with a solid financial future. All right, so Brian, let's start at the beginning. Explain to us what exactly the 10-year Treasury note is.
Real simple, Michelle. It's just debt issued by our U.S. government with a maturity of 10 years. That's why it's called the 10-year Treasury note.
Right.
It pays interest at a fixed rate every 6 months. And at maturity, Michelle, it gives you the face value back to you.
Okay, so it's debt issued by the U.S. government. So what's this debt for? Are they buying it for them? Are they issuing it to themselves? Like who? Explain a little bit more about that.
Yeah, they're issuing the debt out there, Michelle, for expenses of the U.S. government. And that could be for paying themselves, anything that the Treasury allows money to be spent on from the U.S. government. So.
Okay. All right. So then what's up with the spike in the note? Is this happening because we're seeing rising interest rates, or is there something else going on?
Yeah, we always see the 10-year Treasury move hand in hand with the Fed as they start raising interest rates, Michelle. Mm-hmm. And so, perfect example, if I look at history, Michelle, we're literally at all-time lows. If I go back, I ran a chart yesterday showing like a 20-year downturn in the 10-year Treasury note, all the way to March of 2020 when the pandemic shut us down. And at that point, Michelle, we was at like 36 basis points on the 10-year Treasury note. And now, 2 years later, we're at 2.5%, 2.4 as of today. So think of it this way. The Fed's raising interest rates. Everyone knows it. The market's front running the Fed. Okay. So the more that the market runs the Fed up, and up into when the Fed declares interest rates,
right,
it makes it easier for the Fed to continue raising rates. Okay.
Okay.
So in times of uncertainty, like 2020, like the Russia invasion, we'll see spikes down in yields in the 10-year Treasury note. Okay. People are buying them for safety. So when there's massive buying, the yields drop. Okay. Sure. But when they're selling of our notes, the yield rises. That's what's happening right now. We're rising interest rates. And that does affect your investments and everything that goes along with investing in 10-year Treasury notes. So.
Okay. So this is really people moving to safety because of uncertainty. That's why we're seeing more people purchasing.
Yes. When they're purchasing, that forces the yield down. So when Russia, Russia started to invade Ukraine, the yield spiked lower. March 2020, the yield spiked lower. So we're buying safety. And the 10-year Treasury is one of the safest investments out there. Doesn't mean that we can't lose money. Okay. Sure. In a fast rising interest rate environment, you can lose money on a 10-year Treasury note. So, but people buy them for safety. And they sell them when they feel that they can get better use of their money in higher yielding investments. So, and it's funny, Michelle, we'll watch the 10-year Treasury. Every time it spikes, you'll see like the NASDAQ 100 drop because rates are moving up fast, and the NASDAQ 100 is a more speculative investment. So they kind of go inverse to each other. So we watch that really close. So.
Got it. Okay. All right. So let's answer what we're talking about. Let's talk about what we said we were going to talk about in this video. How does this affect the average person, the average investor?
Okay. In a couple different ways. We've probably already mentioned a couple of them. The 10-year Treasury note, like I said, is the most tracked debt out there today. Okay.
Right.
A lot of different rates track the yield on it, like mortgage rates. So as the 10-year treasury rises in yield, the mortgage rates are going to follow it. And that goes right in line with what the Fed's doing right now, raising interest rates. If you watch the 30-year mortgage rates right now, they've moved substantially higher, right in line with this 10-year treasury over the last 2 weeks. And that in turn will start to slow down the economy, which is what the Fed's trying to do. They're trying to slow it down because it's super hot right now. So that's one thing. Also, we just spoke about this. When the yield on the 10-year rises, this can create downward pressure on fast-growing investments like the NASDAQ 100. Now, look, the NASDAQ 100 today is up today. The yield's down on the 10-year. So again, you'll see this inversion between these two.
Right.
And honestly, investors would rather take the attractive yields over speculation.
Yeah.
And they consider them safer. So.
Got it. Okay. How else does it affect us?
How about the rapid spike that we've seen recently is basically the market betting that the Federal Reserve is going to raise rates faster to fight the super high inflation that can cripple the U.S. economy and drive us towards a recession. If I'm not mistaken, I heard a quote yesterday, some analysts talking about now there's a 40 to 45% chance of the U.S. going into recession in the next 12 months. And so that's the fine line that the Fed has to walk to keep inflation under control, not raising interest rates too fast. That's the problem. The faster this 10-year spikes, we need to bring that down. And we need, look, it's okay to have the 10-year go up in yield because it's a benefit to some.
Sure.
So,
but spiking is not what we're looking for.
Spiking is not what we want to see. So, but now let's take the opposite of this. Here's a good news from the 10-year spike for savers. What have we talked about on multiple videos and over the last couple of years, that we're at all-time lows in interest rates? The savers, the school teachers, the senior citizens, everyone a CD holder. You're tired of these low interest rates. You complain every day about your bank not paying you no money on all your savings.
Just an average working person who's trying to just stash cash.
Yeah, exactly. You're losing money to inflation.
Money.
So as this spike is going up, guess what? We're starting to see annuity rates move up. We're starting to see MIGAs move up. We're starting to see CD rates move up. This is good for our savers community. So what is good for some is bad for others. Just remember that. So.
Well, I like, Brian, how you painted a bigger picture. I think it's really important. I woke up this morning, you're like, hey, when we were talking, like, we're planning what we're going to do. And it's like talking about this 10-year treasury note. And I'm thinking, well, who cares? Like, right. But this is great to hear. Really. But it is important because everything is so interconnected, right? When this happens, that happens, and this happens, that happens. And you've just painted a really good picture of why people should care and why keep an eye on this. So
it is important. It's very important to your investments and understanding where you're at in this and how every big move like that in the 10-year treasury or any other, how it affects everything that you do today. So.
Right. All right. If you liked the content of this video, please hit that like button and also subscribe to the channel so you don't miss another video from us. We talk about everything from retirement account and retirement savings to annuities, Social Security, crypto, and we cover news about what's going on just with Congress and regulation and how it affects your money. So make sure you subscribe.
Definitely.
Thanks, Brian, for everything. And thank you to everybody who watched to the end.
Thanks, everyone.